Hi everyone, and thanks for joining this session of the Harneys virtual conference. We're going to be talking today about the life cycle of a company, going from the organizational stage or the launch stage through to the growth phase where founders might be looking at bringing in outside investors, and then onto an exit or a sale of the company, whether by way of acquisition or IPO or some other exit route. My name is Murray Roberts. I'm a director at Harneys Fiduciary based on the west coast of the US, and I've got a couple of great speakers with me. I've got George Weston, who's a partner in the BVI office of Harneys in the corporate team, who will be helping us look at some of these issues from a corporate perspective or a legal perspective. And we've got Amir Weitmann, who is managing partner of venture capital fund Champel Capital, who will be helping us navigate some of these points from an investor's point of view. So before we get into the discussion, I thought it'd be great for the folks who are listening to hear from you guys, George and Amir, get a sense of who you are, a sense of your areas of focus. So George, maybe you could introduce yourself first, followed by Amir.
Sure, certainly, Murray. Good to be here. So as you said, I'm a partner in the corporate team at Harneys. I'm based in the BVI office and I work particularly in the tech and startup sector with companies on all elements of their life cycle, starting with their incorporation, going through their fundraising rounds, and in many cases, eventually getting to a point of sale or IPO. My practice also covers a little bit of Cayman work in conjunction with our offices there, and a little bit of Bermuda work in conjunction with our local affiliate there as well.
Well, my name is Amir Weitmann. I live in Israel and Jerusalem, and I'm managing partner of an Israel-based venture capital fund investing in the Israeli startups, focusing on a number of sectors, mostly food tech, agri-tech. On one hand, so-called bioconvergence, which is deep tech in medical technologies. And we're also doing mobility and fintech and a couple of other smaller subjects. And so far we've done 14 investments, 14 just signed a few days ago, and different sectors, and so far great, we're doing well. And also together with Harneys on the structuration side, we're looking forward to carry on with our success, and we're raising currently a fund, and we hope to be able to reproduce what we've done so far.
Fantastic. Well, thanks very much for that intro, both. So moving on to the first area of discussion, the kind of launch or the organizational phase of a company's life cycle. It's definitely been a challenging backdrop economically in the last year or so. In spite of that, though, times have been busy for startups. They've been busy for the investors who are funding them. You know, startup valuations have been soaring, and a lot of industry sectors have been doing extremely well, possibly because of the conditions the pandemic's created. Things like food delivery, things like remote communications technology, things like home exercise equipment. Even companies like Peloton doing extremely well in the first few months of the pandemic. And the fact that coupled with that, quite famously, there have been some large companies, Uber, Airbnb, that have been founded historically in challenging economic times. I think it's probably fair to say that these sorts of periods are not necessarily a barrier to entrepreneurs or their entrepreneurial spirit. So with all that in mind, the fact that I'm sure, got folks in the audience who are entrepreneurs looking to found a company, launch a business, I thought it'd be good to get some tips from you guys as to organizational best practice and issues to look out for at the launch stage of the company. So George, maybe if we can start with you, can you just talk us through a common organizational structure that a founder might use, and why it might be beneficial for somebody to look at domiciling or setting a structure up offshore?
Yeah, well, for the vast majority of startups, still the hands down winner from a corporate structuring perspective is some type of limited company. That may be an LLC in the US, but in the offshore world, it's likely to be either a BVI business company or perhaps a Cayman exempted company. The main advantage of incorporating is, of course, that you have a degree of limited liability. At that early stage in your development, you may well still be required to give personal guarantees to banks and counterparties, but despite that, there are still a big advantage there. The second big advantage of using a corporate structure is that it is a lot easier to sell shares than it is to give away pieces in in a sole trader business or even in a partnership. So you start typically by looking at a company structure, and then you will start looking about, well, what do the investors in my structure get? When it's just you as a founder on your own, that doesn't matter very much. But as soon as you start taking anyone else in, then questions of voting rights, then questions of economic rights, questions of transferring shares, questions of who has the obligation to put more money into the company, and everything else start to flush through the structure. And you need to think about all of that stuff as early as you can. I think as a lawyer, I would say this, but it's never really too early to take legal advice in your company development. A lot of people think that it is extraneous spend that doesn't necessarily need to be done immediately. Typically, as you'll know as well, Murray, it takes a lot more money to fix issues than it does to start on the right foot initially. In terms of the offshore element, there are a bunch of advantages of offshore which are common to everybody, not just people in the startup or tech sector. Those are around corporate vehicles that are very well known and have international track records, corporate vehicles that are relatively cheap to set up, corporate vehicles that are typically user-friendly and can be customized. BVI is particularly good at this, but can be customized flexibly to meet whatever your expectations are and to achieve whatever you want within reason from a structuring perspective. Both the BVI, Cayman, Bermuda also have ultimate appeal to the Privy Council, or to be more precise, the Judicial Committee of the UK Supreme Court. And as a result, it combined as well, and slightly self-flatteringly, with having sophisticated service providers in the jurisdiction as well who are willing to work with you. The main way in which we see offshore structures being utilized is typically when people are thinking that some of their investment base or some of their operations are going to be international. It may still make sense if you're looking only domestically to look at an offshore jurisdiction of incorporation, but it's more likely to be the case when you are looking to bring in investors from around the world and you want a vehicle that will work for everyone in a tax neutral and flexible way.
That's fantastic. And Amir, if we can turn to you now, I mean, it'd be great to hear your thoughts around some best practices for founders when they're tailoring their products, when they're looking at their approach to market, and if it's even possible to distill this into a short space of time, give us a sense of what are the common characteristics that you look for when deciding whether to invest in a company or not.
Yes. So, sitting in Israel, I'm going to say one thing. Israeli companies have been extremely successful, as everybody knows. And one very significant point that everybody's mentioning is that Israeli founders, because they don't really have any internal market to speak of, Israel being a relatively small country, it's not a relatively small country, it is a small country. So they have to create their companies with having the global markets in mind. What I mean by that is that when an Israeli entrepreneur founds an Israeli company, an Israeli startup, he thinks when he thinks about his potential market, his go-to-market strategy, he thinks about the whole world. And very often you can find in other countries, because they have internal markets which are already relatively large and prosperous, that they are going to concentrate on the local markets. And for that reason, then there's a tendency of limiting themselves, maybe needlessly, to local markets, whereas they should be thinking global. I think that's a good thing, very good thing that there is in Israel, which is one of the reasons why the number of unicorn companies in Israel is almost as big as the entire European continent. It's because they think globally. And I would probably advise wherever a founder wants to start a company, I think they should think immediately from day one, in the same way that George just mentioned, that you don't want to start your company legally on the left foot and then have to kind of correct problems, and because it's much more expensive and complicated, and rather start immediately right, then I would say also on the business side, you want to create a technology, and you want to create a company which is going to be from day one global. At least you think globally. You may not be able to access all markets from day one globally, because we all know that startups have got limitations in their resources, etc. But you have to think about it in global terms. In other words, you have to think, okay, now let's say my first go-to-market strategy is going to be in the US, going to be maybe somewhere in Europe, wherever, but I want to always and immediately think what is going to be step 2 and 3 and 4, and how do I get from this first market to the entire world. I think that's something that's very important. And another very short point is that when you think about your team, in the same way that you think about your sales globally, think about your team as people being able to create the very best technology in the world. If we're talking about entrepreneurship, we're not talking about copycats here. We're talking about having the best of the best of the best on the entire planet. But I think if people get the very best technologies out there and they think about how to sell those technologies globally, I think it can be great.
Well, that's fantastic. It's a fascinating angle. So moving on to the next part of the discussion, the kind of growth phase or the external funding phase. I'd seen some interesting commentary 2 or 3 weeks ago from Dan Primack at Axios, citing some data that had been published by CB Insights, and it was saying that global VC funding, so funding raised by startups from venture funding sources, had reached a record high in Q3 this year, more than double Q3 2020. And what was also amazing was that in the first 3 months of this year, startups had raised more from venture sources than in the whole of either 1999 or 2000, the dot-com boom years. So for companies that are at that stage of their life cycle and they're looking to tap into this incredible funding flow that is characterizing the market right now, I just thought it'd be good to get a sense of some of the issues that might arise in that external funding context. So George, if we can start with you again, can you just talk us through some of the legal issues that might arise when outside investors are being brought into a structure, and how that external funding process can generally work from an offshore perspective?
Well, to some extent, it depends on where you are within the fundraising cycle. If it's your first round of bringing people in, or if it's your second or your third round of bringing people in. I think one of the things that's really critically important for founders or business owners who are going into a fundraising discussion with external investors is to make sure that they have a clear idea in their mind of what they're willing to give up, and also of what they're intending to get out of the process. Are they just intending to get capital that will allow them to do something, or are they really looking for a partner who's going, as Amir and his firm would do, who's going to give them added value as well and expertise on top of that, and help them grow? Because that will be very important. I think one thing that I can't stress enough, even at an early stage fundraising, is bear in mind that what you're giving away will set a little bit of a precedent in terms of further fundraising. It's not necessarily in terms of valuations, because you'd expect those to increase. But if you take someone into 20% of your shares and give them the right to appoint half of your board of directors, when you come to go and get further capital from someone else, and they then want to appoint half of your board of directors, you've got a bit of a problem to think about. So to a certain extent, when you're going through those early negotiations, bear in mind that there's going to be a future context to this, and bear in mind what the long-term objectives of yours are. The second thing I would say is that at that point where you're getting prodded by investors is also when you'll sort of see, maybe you'll see some of the flaws in your business model, but maybe you'll see some of the legal issues that have been generated by things that you've come across in the past. I mean, I worked on a business once where I was actually acting for the VC. We went through the process as we started doing some due diligence, and the company had a very similar name to another company in a very similar industry. And we just said, oh, by the way, we're assuming you've got all the trademarks and everything else for this. And they went, no, we thought we'd do that at some point. And then when we dug a little bit deeper, we found out that they had a series of threatening letters from the people who were using the other name, and that they were pretty soon going to be served with a cease and desist letter, which really would have destroyed the value in the business. So yeah, I guess those are the two main elements. Is first, think about negotiations, think about what you want to give away, think about what you're willing to give away. And then secondly, think about what your company is going to look like externally. And if there's something obvious like that, that just isn't investor ready, think about it and try and fix it, or at least have a good story that you can tell about how you're going to fix it and that you're already aware of the issue.
Yeah, that's great. And I mean, from an investor's point of view, what would your view be around when founders should start to speak to VCs? How does that process work typically? And can you also give us a sense of what a company can expect if they end up having a VC on their board?
Great. So two great questions. I'm going to quote our board member, advisory board member, Amir Weitmann. We're blessed to have him on board. He is the founder and former CEO of Mellanox. Mellanox is the second largest exit in Israel's history. It was sold last year to NVIDIA for $6.9 billion. And 20 years ago, he sold his first company, was one of the founders, was one of the co-founders in a company called Galileo, which was sold for $2.7 billion at the time. So he's one of the very, very, very few people in Israel who's a repeat unicorn entrepreneur. And there are not so many people like that in the whole world. So why did I say that? Because I think his advice is very valuable. So we interviewed him, for our blog on our internet site, and I strongly encourage all of you to go and listen to this interview. It was last July, and we asked him this question, and the answer was: you should get as much money as possible, as early as possible. And my experience is that good companies know how to. They succeed to raise money, and the more they raise money, the more they're successful. So, I would certainly take Eyal's advice to heart. And it comes with challenges. Life is not easy, and the life of entrepreneurs is even less easy. And yes, coming it comes with dilution. It comes with some investors which may be annoying and bothersome in some cases, if you're unfortunate. And yet that's something that needs to be done. It may not have to be done on day one. Maybe you want to take some time to organize yourself and kind of think straight. But at the end of the day, you should try to get money on board, and the faster, the better. Now, what can you expect to go on to your second question? What can you expect from VCs? So the reality is that, first of all, it depends which VCs. There are some, let's not avoid the fact we don't want to be politically correct here. We want to talk straight, right? So let's not avoid the fact that there have been horror stories. I could tell you stories of entrepreneurs telling me, how horrendous it was to have this or that fund on board because they essentially wanted to dictate everything. And they caused harm to the company. You hear stories like that. On the other hand, I think you have many, 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 many stories of great companies which have succeeded in no small part thanks to the VCs on board. So picking up your investors is crucial, because I hope that's how we try to behave. I think that good investors are really, not only as a slogan, but in reality, they are pro-founders, they are pro-entrepreneurs, because they understand that the founders and the entrepreneurs are the ones, as in the end of the day, driving the business and making it succeed. So you need to find somebody who's really going to be like that. And beyond that, you need to have a good, it's very important to have chemistry and a good personal relationship with the people. Because otherwise it's not going to work. At the end of the day, we know, especially in a startup, it's all to do with people. And if two people at the top don't go together and can't work together, it's a big problem for the company. So I would say these are some of the issues. And, you know, in terms of what they can expect, well, it depends in terms of valuation. I think typically a VC will try to take, I mean, a round will be 20 to 30% dilution, depending on the size of the round, etc. There are, you know, very clear criteria. We can't go into it now in too much details, but I think there are, you know, rules of thumb which are pretty much now accepted in the investment community. So if you're going to see a term sheet given by somebody who deviates too much from these rules of thumb, then I think there's a problem. So, you know, go for, in that respect, from the technical side, go for something, I would say, which is reasonable, which is in line with market expectation.
Fantastic. That's some great insights. Thanks, Amir.
Can I just come in real quickly, Murray, on a couple of things that Amir just mentioned there? I think one thing that Amir mentioned was term sheets. And as a lawyer, I love term sheets. It's great. You will save a lot of time, yours and your legal teams, which means you'll save a lot of money if you come into negotiations with a term sheet or something written down that's reasonably detailed. Sometimes I think particularly people who are not necessarily super experienced in the business world think that if they're going to have a negotiation, they might as well negotiate the documents instead of negotiating the term sheets. But I would say that that's very, very much the wrong approach. The second thing I would say, and to perhaps try and put slightly more eloquently the point I was making and emphasize what Amir was saying, it is very important that the founder can live with the deal that they're doing, because ultimately the success of that company will depend on the founder being engaged. You're going to give up a level of control, of course, when you're taking someone else's money, but it needs to be a deal you can live with.
Great, and I appreciate the input. I mean, just moving now onto the kind of exit or the sales stage of the life cycle, and just looking at what the market has been doing both in the years running up to the pandemic and in the last couple of years. I mean, I think in the period leading up to the pandemic, it had become fairly common for companies to stay in the private funding ecosystem for longer periods of time. In some cases, you know, staying private, raising a Series F, a Series G, and to a certain extent, you know, shying away from the public markets. And I think a change that's been happening in the last 18 months or 2 years in the markets has been, and it's probably to a certain extent driven by the rise of SPACs, special purpose acquisition companies, that have been taking earlier stage companies, pre-revenue, pre-profitability stage companies to the markets quicker, giving them a path to liquidity a bit quicker, has been to remove companies from that private funding ecosystem and give them that exit route. So in that vein, George, again, you know, starting with you, what sort of exit options are available, whether it's acquisition or IPO or SPAC business combination, to those who are operating offshore structures or investing in offshore structures?
Well, at a fundamental level, I don't think there's very much difference between the exit options for someone who's got an offshore structure versus an onshore structure. And the key thing about the offshore element is that everything is on the table structuring wise. BVI, for example, very conducive to listings. It's very conducive to sales. You can do statutory merger, which is very similar to Delaware. You can do schemes of arrangement. You can do plans of arrangement, which is a bit more of a Canadian concept. You can do a simple contractual sale, which would be typically how things would be done in the UK and in the US for private companies as well. So you have a range of structuring options, and everything's on the table in an offshore world. You're also likely to have, unless your offshore company is tax resident somewhere else, a rather simpler discussion around the tax structuring and everything else. Coming back to the sort of range of exit scenarios more generally, I think most companies, most startups, and certainly the successful ones, will come into it with a bit of an idea and an expectation as to what kind of exit is most likely for them. If you haven't thought about how you're ultimately going to make money from your business, then you're not likely to have a particularly successful business. And that also applies to how you're personally going to make money, as well as to how the business is going to make money. For example, if you are Uzbekistan's answer to Amazon, then you might be thinking that your ultimate goal is to be bought by Amazon or a rival of Amazon's. So sales and acquisitions, you've really got kind of two options there. You've either got what we would call an industry buyer. So you've got, in that example I just gave, you've got Amazon, who are operating in a similar space to you and want to bolt you onto them because you give them either an additional tool or you give them an additional bit of market coverage that they didn't have before. You also can have bolt-ons that are just adding a certain bit of technical expertise, or supply chain bolt-ons where you're going to plug a gap in someone's supply chain as they sort of go from the corporate equivalent of farm to table and make sure that they have every element of that supply chain vertically integrated. And then in the acquisition side, you've also got private equity sales, which may be less attractive to people in the tech sector because it will probably involve losing quite a lot of control. But again, that may be attractive. And when I say private equity, I'm talking more about traditional private equity versus venture capital, which typically is much smaller stakes in companies. And then looking at your options about becoming a public company, that is always an intrusive and slightly invasive process that will require having every element of your business, from your legals to your financials to your accounting, all done to a certain standard. The interesting thing at the moment in that market, as you say, Murray, is the SPAC element of it. There are a lot of SPACs out there that have raised well over $100 billion that sat there unused at the moment and that is looking for homes. And that's to some extent squeezing out traditional private equity out of structures. And to some extent, it's squeezing out traditional IPOs as a route of getting into market. It can be a slightly easier route. And you also get access, of course, to the SPAC's management team. And you get access as well to the pool of capital that the SPAC raised on the stock exchange. So that might be a very interesting option for people as well.
That's great. Thanks, George. And Amir, can you talk a little bit about the role of an investor in identifying when might be the right time to exit a business, and maybe some of the lessons from the exit scenarios that your fund has been involved in?
Yeah, so we actually have had already 3 exits, and the 4th one is actually happening now, actually, where our company just got a term sheet. So I've seen already M&As, I've seen a SPAC, I've seen an IPO, and I have some personal lessons. So first of all, I would say concerning the SPACs, well, it has last year and the beginning of this year, it was very, very in vogue. It was very popular. I have second thoughts about it. Often the problem with SPACs is that often companies become public too early. So it's a way for them to get a lot of money fast, which may be very good for the company. It may not be good for the shareholders, because if you look at what's happening, most of the companies which have gone public over the past 12 to 18 months are probably trading at a discount, some at a significant discount, as opposed to the price when they went public, which is of course not very fun for SPAC investors. That's one point. Second point is that I think that the exit venue is of course very important to think of. But having said that, the most important point is to think about creating a working business. Because if you have a business which is profitable, growing, growing and profitable, growing both in terms of geographies, in terms of the market penetration, etc., then at the end of the day, you will probably find an exit venue. Somebody is going to be interested in your business if it is profitable, and if it's not profitable, then it's going to be complicated, if not impossible. So I would say, yes, think about the exit, but most of all, don't be obsessed with the exit. Think about creating a working and profitable and great business. That's, by the way, Warren Buffett said that many years ago. So and he was right, of course. So I think that's my advice, I would say, to the founders, is make sure that you make money, make sure that you grow your business, that you grow your revenues, and then one way or another you're going to find an opportunity to become public, or to be acquired, or to find any way of having an opportunity to exit. But don't be obsessed with it. But then on the flip side, if you have an opportunity to exit, which is exactly what happened to one of our companies right now. Even if it's not, I would say, the most amazing exit possible, but if you think that it's going to be difficult to create value under the current circumstances, then you should also know how to say, okay, for instance, I wanted to sell my company at $1 billion, but now I have an opportunity to sell it at $300 million. And you know what? It's going to be complicated and challenging to grow my business from 300 million to 1 billion. Let's sell. That's legitimate. So it's a very, very complicated question. And just to sum up, think about making your business great and profitable. But if it's too complicated, or if you think that at some point creating value becomes really challenging, both for yourself and for the shareholders, then, and if you have an opportunity, then think hard and long and hard before you refuse it.
Yeah, that's some great advice. Appreciate it. Well, I think we're pretty much out of time. It's been an absolute pleasure to hear your insights, Amir, and yours as well, George. I hope the audience has enjoyed listening to you guys as much as I have. Thanks everyone for joining. Please do stay tuned for the next installment. It's going to be hosted by Phil Graham, my colleague, who's going to be looking at why emerging managers should use a BVI fund structure. So thanks again.